Good afternoon, everyone. It's great to have all of you here today. Thank you for taking the time to join us. I am Det Arwego, Managing Director of Assessment Analytics, and it's my pleasure to welcome all of you to today's session entitled Take Control, Plan Well, and Live Well, Turning Your Salary into Sustainable Wealth. Now, before we officially begin, may I request everyone to kindly turn on your cameras for a very quick group photo? Okay, so while we're waiting for all of you to turn on your videos or your cameras, I just want to let you know that today's webinar is part of our series of 20 complimentary webinars in celebration of our 20th anniversary. And as we celebrate this milestone, we remain committed to sharing practical insights and creating meaningful conversations that support both personal and professional growth. Please also note that today's session is being recorded and may be shared on our social media channels. So that would be in YouTube, Facebook, and LinkedIn. Ray will be posting the links also in our chat, so please feel free to follow us there. And once again, welcome to today's session. While many of our webinars focus on workplace and organizational topics, today's session touches on something that affects all of us personally, and this is financial wellness. Financial wellness plays an important role in our overall well being, yet, it is often something we don't spend enough time planning for intentionally. Just as organizations rely on long term planning to achieve sustainable success, building financial security also requires a deliberate and strategic approach. And in today's environment, earning an income is only the starting point. Achieving financial wellness requires clear goals, disciplined habits, and informed decisions that help us navigate both opportunities and uncertainties. In today's session, we will explore practical ways to manage our financials more effectively, develop healthy financial habits, grow wealth through investing, and prepare for both planned milestones and unexpected life events. More importantly, we hope that this webinar will provide practical insights that can help us build greater financial confidence and long term financial well being. Now, to guide us through these important topics, we are very fortunate to have with us a highly experienced professional whose career spans both banking and wealth management. And on a personal note, I'm especially pleased to introduce our speaker today because Rose and I first met at HSBC nearly 30 years ago. It has been wonderful to see how she has continued helping individuals and families build financial security and achieve their long term goals. Miss Rosemary L. Santiago is a certified wealth manager, financial advisor, and former banking executive with nearly 4 decades of experience in the financial services industry. Before transitioning into wealth management, she held various leadership roles at HSBC Philippines, where she spent over 16 years managing key corporate relationships and delivering financial solutions to both local and multinational clients. She currently serves as a wealth specialist with Manulife Asset Management and Trust Corporation and as a financial advisor and certified wealth manager with Manulife Philippines. For the past 13 years, she has been helping individuals and families build, protect, and preserve their wealth through sound financial planning and advisory services. With her extensive experience in both banking and wealth management, Rose truly brings valuable insights on personal finance, investing, and long term financial wellness. So, now please join me in giving a warm welcome to our speaker, Miss Rose Marie L. Santiago. Rose, the floor is now yours.
Thank you so much, Det, and good afternoon, everybody. Welcome and thank you for joining this webinar this afternoon. This is just one of several delivered to you by AAI this 2026 as they celebrate their 20th anniversary. I am Rose Santiago from Manulife and so very, very pleased to be with you all today. I'd also like to thank, of course, AEI for organizing this financial learning session today. All right. So let me speak about how we can take control of our salaries and savings. And of course, at the end of the day, and by the end of this session, hopefully you'll be able to learn more concepts on how to build and maintain sustainable wealth. Okay, let's first tackle the financial literacy landscape condition in the Philippines. Financial literacy is described as an ability to comprehend the concepts, understand them better before making any money decisions. In the Philippines, only 2% of Filipino adults can confidently answer questions about the topic. Our aim, therefore, is to promote financial education through webinars such as this. And at the end of the session, we aim to improve that level of awareness. So let's learn the value of savings, insurance, and investment as you and I journey on to financial freedom. Okay, out of 100 Filipinos who are at age 65, we want to take notice that only two are financially independent. 23 have decided to continue working even beyond their senior years. 30 are dependent on charities. And as the Filipino culture would show, we have very tight family relations. Therefore, 45 out of the 100 Filipinos are still dependent on relatives. So financial security is the key to remove these situations we are in. So we want to build more confidence to weather any financial storm, be able to live comfortably, whatever is the lifestyle that we currently enjoy today. We want to have to continue that and not worry about money. When we do that, we truly would have financial peace of mind. Now, during our productive years, we have several expenses that we want to be able to cover from our income or salaries. So we cover basic necessities, monthly utilities, and as we grow and start our family, we would probably borrow money, take out loans to fund certain milestones. When we start having children, we get married and start having children, we want also to prepare for the education of our kids. And together with that, we also want to be able to have enough healthcare services to provide the peace of mind also for any eventuality of illness. And of course, we want to build a home. Now, what happens here is during the productive years uh, when we experience these expenses, of course, what we experience in life is we have the tendency to see that our savings allocations have a tendency to go down. Now, what happens when our savings do not uh, necessarily provide us with enough buffer for certain ifs in life, such as uncertainties with regards critical illness? Whenever we take a look at how our healthcare services can provide the enough funds for us to be able to look at our own health and disability that may come from health issues as well, or maybe disability from accidents that will create less income when we cannot afford to work anymore. And of course, the uncertainty of death. So these will naturally also occur and create more uh, more pressure on our finances. So, with these uncertainties, we take a look at life insurance to cover for these eventualities. It's the money that the insurance company promises to pay to save you from disrupting your finances. As we move on and near our retirement years, so as you grow older, you experience less expenses, probably because your children are already independent. They don't rely too much on you. You can redirect more of your income into saving for retirement. At your retirement years, however, you still have to carry certain responsibilities for yourselves, like the basic necessities, utilities, of course, healthcare, which could still be costly. So, what happens when you live long? Okay. So, with that, you also expect certain ifs. The uncertainty also of not having enough funds when you grow older. So, this is another factor that we have to consider when we grow old and we live longer than we expect. Now, let's take a look at how our money grows over the years. So, very quickly, this is how we take a look at the value of our money. 26 years ago, you would probably be able to carry so much groceries from a mere 500 peso budget. And today, your 500 peso budget would only give you a bag of groceries. Furthermore, you would also notice that in the year 2010, your 5 peso could buy you 5 pieces of pandesal at 1 peso per piece. Today, that's hardly the cost of a pandesal. You would probably only be able to buy 1 piece today. So that reflects the concept of inflation. So that refers to the increase in the general level of prices of goods and services over a period of time. So the higher the inflation rate, of course, the lesser the value the money becomes. Okay, so saving for the future is what we want to focus on. So, what do employees save for? So, if your method of saving for the next probably 10 years or so is the traditional way, think again. Because in reality, this is what usually happens. Let's say, for example, you're saving for a college tuition fee of your 5-year-old child today, or you're planning to get married in 10 years, or you want to put up a business when you retire, probably in the next 20 or so years. So think about it. The cost of tuition today will definitely increase over time. The cost of materials and services needed to organize a wedding will also inflate in 10 years. Our living expenses during retirement years, 20 to 30 years probably from now, will also increase. So, if you are looking to save your money in the bank through a time deposit, and if the inflation rate today is at 7.2% as of the BSP data in April, so if you start saving your 100,000 today, 2026, and your time deposit or savings interest rate is at 0.25%, with an inflation rate of 7.2%, fast forward 5 years from now, your 100,000 5 years ago would give you a value of 101,256. In input the inflation rate to that 100,000 that you save in the bank, the effect would be that your 100,000 would probably only have a value 5 years from now of 68,824. Okay, so the gain from time deposit is very small. The value is lost because of inflation, and therefore the loss of purchasing power. So, how do you beat inflation? What we can do is wise investing or making more of the money that we keep. There are several ways to start investing, and there are a lot of investment instruments that don't necessarily require a huge amount to start. Just keep in mind that when you start investing early, you do not delay the opportunity for your money to grow. You can always maximize the market's potential, diversify to lower risk, and eventually get higher returns for your investments. So, when we go back to the situation where we said that if we live too long and whether our savings will be enough to sustain our expenses when we grow older, the solution is long term investment. This will help take care of the expenses that we will have during our retirement years. So, how can you make the most out of your salary? All you need to do is disciplined savings or keeping more of the money that you earn. So, don't save what's left, but spend what is left for savings. The wrong way to save is whatever you receive from your salary, then you spend X amount, then whatever is left is for savings. The right way is, of course, plan the amount that you want to save from your salary and work on a budget for your expenses. So that way you pay your future self first. So set aside the money that you want to save for yourself for the future. Ideally, that should be about 10 to 20% of your monthly income or salary. So, how do you create an effective budget? First, you examine your expenses. Reduce or eliminate the non essentials. You set a reasonable amount for those expenses, what you have to cover on a day to day basis or on a monthly basis. So, set an amount for those. Of course, get inputs also from your family members. They may be able to help you rationalize the expenses from the household. The best way to keep to a budget is to write it down. Do not memorize, rely on tracking your expenses by creating a list. Then set aside a monthly amount for some periodic or irregular expenses, such as payment for car repairs, payment for household repairs. So you also have to anticipate that there will be other expenses that you may not necessarily have to predict. Then implement your budget. And lastly, when you write down your plans for your budget, make sure that you're able to track your spending and then adjust the budget when necessary. Okay, now saving money is all about setting a portion of your income based on how much your salary can allow. But do it deliberately and, more importantly, do it consciously. So let's take a look again on the different uncertainties that we discussed earlier. So, for critical illness, disability, and death, your life insurance policy will protect you from those uncertainties. Now, living too long in your old age, the solution that you can run to would be to prepare and plan for long term investments. So the choice is really yours. You save money, take control of your salary, create a plan to build and grow your wealth so that you can cushion the impact of life's uncertainties. So, what exactly do we do when we want to plan well and to live well? You want to future proof your family, employ certain financial habits that will work. You will aim to live well in all of your productive years up to retirement by planning well for life's milestones and being prepared as well for those uncertainties. So, why are we here? Okay. What specifically brings all of you here today to listen and attend this webinar? Can I ask you to please type in the comments box your topmost reason or purpose for saving? Would it be for retirement? Would it be saving for your children's education? Are you also saving so that whatever lifestyle you are currently enjoying, you can maintain that in your older years? Are you preparing to build a home? So you want to save enough funds to be able to build your ideal home? Or maybe make sure that you are also prepared to save for those uncertainties or save for a rainy day. So, what do we actually do? This is called goal based investing. Have a goal in mind, start with the end in mind. So, if you want to save for a child's education, build a home, maintain a particular or keep a particular lifestyle, prepare for those uncertainties, and set aside enough for your retirement years. So that is goal based investing. It's not just the common notion of goal based saving, but goal based investing. So, why is savings not enough? So, let's take a look at the PSP time deposit rate historical data starting in the early 80s. So if you see in the chart here, before the year 2000, time deposit rates around that time was about 10%. With just a few occasions, it fell below 10%, but for the most part, it was above 10%. But nowadays, year 2000 and onwards, the rates have been below 10%. So you can see that the rates of time deposits have been below the 10% mark. So you can imagine what the savings rate could be. So as we all know, time deposit rates are slightly better than a savings rate. Some people believe that those rates are okay, but not today. That was before the deposit rates were high. It still takes many years to double your money. If you're familiar with rule of 72, the rule of 72 is whereby you want to determine how many years will your money double. So the rule of 72 is you divide the number 72 by the deposit interest rate, and the result would be a number that represents the number of years it would take to double your money. So, for example, if the interest rate in the early 80s was at 6 or 7% time deposit rate, that would more or less mean doubling your money in just 10 to 12 years. So, then why is savings not enough? So, that's the first reason. It's a systemic issue. Plus, saving leaves you vulnerable to a thief. So let me explain. Where money is lost not in terms of value, but in terms of purchasing power. This person or this thief who we're talking about is inflation. The numbers that you see over time is inflation. The 307,176 lost from your 1 million 12 years ago is the outcome or effect of inflation after 10 years, leaving you with just 692,824 of purchasing power. The 1 million is still intact, right? But in terms of goods and services that you're able to purchase, you will have less than 700,000. Hence, you have to have the right formula. So, what is the present rate of savings and time deposit? Most of the time, inflation, especially nowadays, we had a high of 7.2% inflation in April, is higher than your savings account interest and time deposit rate. So, what should you do? You choose investment so that the rate of return, of course, is higher than inflation. If your savings account interest rate is less than inflation rate, you're at the losing end. That's the only time you could win and be better off when your interest rate is higher than inflation. We go back to why we do goal-based investing than goal-based saving. So first, identify what in particular are you investing for. Next, determine whether those goals are short, medium, or long-term goals. And lastly, choose a product that will correspond to your investment goal. So let me give you a few examples. Okay. If you're saving for a Japan trip, probably by the end of 2026, determine the length of time that you would need to save up for it, given that it's just a few months ahead. This is considered short term. So short term is actually months, less than a year, or even less than 2 years. So what to do? Put your money or invest it in a time deposit account because the time horizon is short. The other example is if you're planning to save, for example, for a car down payment by 2028. So that's a year and a half or 2 years from now. The goal is to save for that in 2028. So that's 2 years from now. We can consider that as medium term. So medium term is about 2 to 3 years. So what do? We invest that money in a UITF or Unit Investment Trust Fund, which I will cover in the coming slides. So medium term, 2 to 3 years, it's okay. You can invest the money in a UITF so that you will be able to get the amount that you need to save for that car down payment 2 years down the line. For example, you want to save for your retirement. If you're at 40 or your late 30s, so that would probably be about 20 years from now. Determine the time horizon, so that's long term. So 20 years is a very long term. So you can invest also in a UITF, even if the risk is higher, the exposure is higher on aggressive funds, but they have the potential for a higher growth or return in the long term. So when do you start investing? Okay. If I would ask you again, could you tell me when you think we should start investing? So quickly type in your answer on the chat box. If you know when is the ideal time to start investing. Okay. Let's take a look at an early investor versus a late investor. Okay. So here we have two individuals. One is an early investor. She's 20 years old today, born in year 2006. She decides to invest monthly 1,000 pesos, or that's 12,000 per year for the next 20 years. So after 20 years, she would have had a total investment of 240,000. So the 240,000 is spread out over the next 20 years. Assuming a 5% return per annum on her investment, then you will see the bullets down there, how much we can project her investment's value would be at 30 years old, 40 years old, and 50 years old. On the other hand, think about a late investor. This guy is also born in 2006. He's 20 years old today, but he started investing at 30 years old in 2036. The monthly investment he decided to put in was at 2,000 or 24,000 per year for the next 10 years. Total investment is still 240,000 spread out over 10 years at a 2,000 per month investment. Assuming the same 5% per annum investment return, his investment value at age 40 would be 358,011 on the 10th year. And on the 20th year, when he turns 50 years old, the value of his 240,000 would have been 583,162. So again, the total investment is the same amount. So why the difference? It's really the time element. So what is working here? It is the magic of compounding. So you start investing early. For example, if you're targeting to receive a 1 million savings by age 60, and you're looking at an investment with an annual interest of 6%, so the advantage of starting early is that if you started at age 20 to achieve 1 million by age 60, so that's 40 years from now, you would only have to set aside 500 pesos. At age 30, you would probably achieve your 1 million with just 990 pesos savings every month. At age 40, you achieve your 1 million after 20 years by setting aside 2,150 per month. However, if you're only saving today and you're at age 50, you would necessarily need more money to set aside to achieve your 1 million in 10 years, and that's 6,072. So see the advantage of starting early. It doesn't hurt to begin saving at a very small amount. You will still be able to reach your goal by starting early. So the power of compounding is illustrated this way. So if you were saving for the next 40 years and the amount you're saving is 1,000 per month, and this time it will earn you 7% yearly return. So the amount saved after 40 years would be 480,000. And the green bars will show you what the accumulated value would be after 40 years. So if you were saving enough and long enough for the next 40 years, your 480,000 total savings would yield you 2.6 million at a 7% yearly growth rate. Okay, so the magic of compounding is very clear. So what you have here is earning interest on interest, then earning from both the principal and the accumulated interest. So you're making money, your money is making more money over time, which is called the snowball effect. So when the snowball rolls, it picks up more snow, enlarging its volume. The early investor earlier had more earnings because she had more time, even if the amount invested was the same. So, what's your financial workout plan? First, you have to build a strong savings habit. Warm up with a budget. Track your income and expenses to see where your money goes, and you will be surprised. Once you do that, then it leads you also to rationalize where your money goes and focus on what really matters and what is essential. Do short repetitions for bigger gains. Start with a manageable target. Just treat it like your daily workout. So it's muscle memory. Consistent repetitions will definitely lead to long term results. So the next question is where to invest. What are the common investments available to us? Okay, let's start first with a risk reward trade off. So here we want to introduce this concept whereby you put your money where there's a potential return on it and there's a corresponding risk. We call this the risk return trade off or risk reward trade off. For example, you're just used to deposits and you don't want any risk, which makes sense, of course. You don't therefore expect high returns from your bank deposits. Then you move up to other kinds of investments like bonds, fixed income securities, and stocks. In terms of potential return, you're looking for something with higher or better return, but you're exposing yourself, of course, to higher risk. It is so with the case of stocks. This has a higher potential return than bonds, but will expose you to higher risk. And the alternatives, including real estate, which is way up the line, has also higher risk, but possible potential higher return. So the line that we created here is called the risk reward trade off. So, what are the common investment options available to us? So, first, you have your time tested deposits. So, the investor loans money to the bank for a defined period of time with interest. So, an example of that is keeping your money in the bank, a savings, an ATM passbook, or a checking account, or bank certificates or time deposits. There's still a risk on deposits. It is the credit risk. So the borrower may not be able to pay you. But this is very, very low for the highly rated banks. So the probability that they won't pay you interest on your deposit is very low. The cons here is, of course, with a low risk type of investment, then there will necessarily be a lower yield. Bonds. So the investor borrows money for a definite period of time with interest, promising to pay you a certain type of interest. These come typically in the form of government and corporate bonds. So generally, bonds are less risky than stocks. But there's still, of course, a credit risk. The borrower may not be able to pay you. This is low for the highly rated corporations and virtually zero for government. The cons, again, is of course there's a higher minimum investment requirement, especially for Philippine government securities. Okay. You have stocks. Stocks represent ownership in a real business or corporation. A share of stock is a single unit of ownership. The shares are sold to you, and the money that you pay for the shares is being used by the business to grow or expand. So, how do you earn from stocks? You earn from stocks from capital appreciation. So, there is an expected increase in the price or value of the asset. You also earn through dividends. Some Stocks pay dividends, which is received regularly by a company, which is paid regularly by a company to its shareholder out of its profits. The risks that we're taking from stock investing is, of course, the prices can go down. And the con in investing in stocks is you really need to employ a lot of research and analyze what you can buy and when to sell your stocks. So there's a lot of research that goes into investing in stocks. Okay, other common investment option available in the market is what we call the collective investment schemes. In the Philippines, we have three. So these are UITFs or Unit Investment Trust Funds. You also have your single pay variable universal life or VUL and your mutual funds. Except for the VUL, the UITFs and mutual funds are pure investment. For VUL, your investment carries with it an insurance component. So it is a collection of stocks and bonds bundled and sold together. It offers a diversified portfolio, investing in more than just one company. UITFs, VULs, and mutual funds require a lower minimum capital outlay. There's also minimal research needed. Why? Because the fund managers of the trust entity, the life insurance company, and the mutual funds company will take care of that. As a result, there are transaction fees, but those transaction fees are low. The risk, of course, is that the prices of your UITFs, VULs, and mutual fund prices can go down because it is still invested in some risky assets bundled together. So let's take a deeper look into unit investment trust funds because this has been the more common and easily accessible solution to investing. So what is a unit investment trust fund? It's an open-ended pooled trust fund denominated in pesos or any acceptable currency. It's operated and administered by a trust entity and made available to us by participation or subscription. These were launched in the Philippines in 2004. They're widely available through banks and trust corporations. The good news about UITFs nowadays is you only need as little as 1,000 to 5,000 pesos to participate or subscribe to a UITF fund. So just to give you a quick view of how we earn or how the UITFs operate. So we pull money together from several investors who decide to invest in a particular UITF. These UITFs are professionally managed by investment managers of a trust entity or a bank. And in return, the investment managers decide the strategy for investing our money in different securities, bonds, and other assets that, of course, will expect to generate returns for us investors. And those returns are given back to the investors in the form of higher unit investment trust fund prices. So when you invest in a UITF, you're actually investing in the expertise of the investment managers running the trust entity. So earlier we were talking about stocks where you need to do a lot of research. There is very little research that you would have to employ on yourself when you are investing in a UIPF. Okay, so now in summary, how do we plan well so that we can live well? What we've learned today is number one, you start with an investment goal. So this will determine your time horizon. Take note also that inflation is a silent thief. Okay, so we have to have the right formula. We have to invest rather than save. So goal based investment rather than goal based saving. We saw also that compound interest works like magic. So start early. And then let the professionals do the investing for us because we lack the time and expertise. There are pooled funds such as those I mentioned earlier, the UITFs. And then we also need to diversify. No single asset class consistently leads across different market cycles. So when you're looking at the UITF, what is important is you also diversify. So the common concept here is not putting your eggs in one basket, put them in several asset classes. So make your investing seamless and effortless. You can open an online investment account with your bank. Some financial institutions can also offer you automation for your investment activity. So if you're saving regularly, then there are also regular savings plans or similar approaches that trust entities, financial institutions can offer. All right. So that ends my presentation today. Please let me know if you have any questions. We can open the floor for the Q&A.
Rose, for sharing your expertise with us. Um,
You're welcome.
yeah, so as you mentioned earlier, now we're gonna open the floor for questions. If you guys want to ask any questions, please feel free to type it in the chat. And I'd be happy to read them out loud. But before that, I would like to start the questioning also with some questions that were sent to us privately. Um, One of the questions, but this was earlier in the your presentation, is where do you start? In terms of investing, there were a lot of options that you presented earlier, all of which were quite well, had a balance of both risk and return. Where would you start?
Okay. For first-time investors, what we normally go through is financial needs analysis. So first, we have to determine what your goals are. If you're a first-time investor, we will ask you first how much of your available cash is available for emergency funding. So when you start investing, the primary prerequisite is you should have a safety net. That
Okay.
safety net will come in the form of an emergency fund. So why do we say that? Because investing is ideally a way to go for growing wealth, provided that your investment horizon is medium to long term. So
Uh,
if you have a very short term horizon, your investment may not necessarily yield the gains or returns that you want at the future time. So we go through a financial needs analysis.
okay.
First time investors have to ensure that they have a safety net, an emergency fund before investing. So the right time to invest is really it varies from one individual to another depending on where they are and what their current financial standing is.
Okay. So in other words, we secure our safety net before we start placing
Investing.
wherever before we start investing. On that note, on the investing note, no, I have another question here: is how do you manage risk with all of the options? How do you manage your risk?
Okay. You manage risk by determining the portfolio that you want to put your money into. So when the financial institution or the trust entity offers you several investment options, they will take a look at what we call your risk appetite and your risk capacity. So the risk appetite determines your feeling or your emotion about taking in risk. And then your risk capacity determines how prepared you are in accepting certain losses. So, for example, if you want to manage the risk, you have to determine whether you can take in more risk or you're not willing to take in so much risk. Therefore, there are three different classes or categories of investors. First, you may be a conservative investor, so you don't want so much risk. You may be a moderate risk. You may be a moderate investor, so you can take in a little risk, but not too much. Or you could be an aggressive investor. And for the
Mm.
most part, aggressive investors have a longer time horizon. Okay, so in all cases, Paulo, the key here is how long are you willing to stay invested?
Okay.
If your time horizon is long, you can afford to take in more risk. But again, the suitability of the person to take risk depends on his risk appetite and risk capacity. So we're very careful in determining which funds to recommend for certain investors because we want them to take responsibility for the returns or for the outcomes of their investment. So how do you manage risk? It's determining your own personal appetite for risk and your capacity to take risk.
Got it. All right. So I have one last question here now. Um, so it says that if I am looking to diversify where I invest, is there a magic ratio um in placing my investment?
Okay. All right. For for an investor that wants to diversify, you have actually two categories to consider. So you consider diversifying into safer assets and a percentage into higher risk assets. So that's one. And number two is the place or the type of sector that you would want to put your money in. Many trust entities nowadays offer both local, global, and regional investments.
Right.
So in making a good mix of your portfolio, consider also global funds that have better potential for growth. Okay, Paolo, nowadays, we have also been pushing for more diversification into global and regional funds. Why? Because the local Philippine equities and bonds have not been performing as well as our global and regional counterparts. For example, the Philippine stock market has experienced so much volatility that the Philippine Stock Exchange Index pre-pandemic was at something like 8,000 PSEI index.
Okay.
Today, we are just at 5,800. So
Okay.
after the pandemic, you will see that the Philippine market has not really gained so much return over the past, what, 5, 6 years. Whereas our
Hmm.
global counterparts post-pandemic have shown much more traction in terms of gains on their investments. So to balance off your portfolio, consider not only the Philippine market, but try to explore global markets as well. And the banks. and financial institutions are now offering a lot of options, especially for UITF, to invest in
Okay.
global funds. And you don't need dollars.
Mhm.
You can invest your pesos in a global or a regional fund.
All right. So I have a few more questions that just came in. So
Go ahead.
we have one from Miss Rosemary Santana. How much emergency fund should we set aside before investing?
Okay. It will depend on your current stage in life, I would say. So if you're single, unmarried, and probably not having any dependents, then your expenses would be low. But the rule of thumb really is whatever is your monthly expense, your emergency fund should at least be equivalent to 3 or 6 months of your monthly expenses. Why? Because if you're going to invest and you don't have enough 3 or 6 months worth of an emergency fund, then in the event of a need for cash and your investment hasn't really picked up enough returns, let's say over the short term, then the likelihood that you would turn to your investment and redeem your UITFs or withdraw from your investment is very high because
Mhm.
your emergency fund cannot cover for certain unexpected expenses. So the rule of thumb is really 3 to 6 months.
Okay.
Probably for those who are who have growing families, so you have a lot of dependents, then probably a little bit more than 6 months would be the ideal factor to determine what your emergency fund should be before you even start investing. So when we do our financial needs analysis, you have to be very upfront to your advisor or to your investment manager to help you maneuver through investing with the right knowledge and the right backup with whatever funds you have existing in your portfolio.
Right.
So take a look at your emergency fund. If you have enough, then you can start investing. If you're still building your emergency fund, then you would probably stay away from risky investments. You would probably put a little of your savings into the bank or a time deposit. And until such time that you have that emergency fund increase over time, then any excess over your emergency fund can be invested into the different investment options we presented earlier.
Awesome. All right. So I have two more questions. We have
Go.
like a minute left. So the first question, if someone starts investing like in the example you shared earlier and stops after 10 years, for example, what will happen to the investment?
Okay, if you start investing and you keep the money there after 10 years, the question is what happens to your investment? It will give you the return at that point in time. So investments will not promise you a steady return, but
Mhm.
if you have a goal that you need the money in 10 years time, then take a look at the specific fund that you're getting into. Okay, so
Got it.
the investment that you will reap after 10 years will depend on the actual performance of the fund after 10 years. In most cases, Paulo, the financial institutions, the trust corporations will give you a historical performance of their funds.
Mhm.
Okay. But there's a caveat to that. Historical performance will never be a guarantee of future performance. But then,
Mhm.
when you decide on which fund to invest in, obviously, you will rely on historical data. So I suggest that when you choose the funds that you want to invest in, do the little research that is available by taking a look at the historical performance of the fund. Okay. Like, for example, I mentioned earlier that the Philippine Stock Exchange prior the pandemic was at a level of 7,000, 8,000. Today, the Philippine Stock Exchange is at 5,800, the index. So you can see that most likely an investor will not put his money in the Philippine market, given that historical data. Whereas we have other global regional funds that have a better potential for growth.
Us. All right. And one last question. Um,
Go ahead.
given the state of the economy, what investment options would be best?
Okay. The best investment option nowadays is because frankly, Paolo, a lot of the investors nowadays are really looking into alternatives because their Philippine investments are not giving them the returns that they expected. Okay, so given the situation today, the economy, our investment managers have an outlook on the Philippine economy whereby we do not see stabilization, recovery within the next 2 years. Okay, so think about what we can do for you in the next 2 years, and that's diversifying your current portfolio by reallocating some of your investments into higher yielding or better performing funds. So if you have um, existing investments in Philippine stocks or bonds,
Mhm.
then you can choose to reallocate those funds into global or regional funds.
Awesome.
Because the Philippine market, as I said, the outlook of our investment managers is that we do not see any recovery or catch up among our Asian peers in the next 2 years.
Right. Yeah, and on that note, no once again, thank you everyone for taking the time to join us this afternoon for our webinar. We hope today's session was has provided you with the practical insights for building a healthy financial habit, making informed decisions that support your financial well-being. We would also like to, of course, extend our sincerest appreciation to Ms. Rose Santiago for generously sharing her expertise, her experience, and her valuable insights with us today. As a part of the continuing celebration of AAI's 20th anniversary, this webinar is just one of many learning opportunities that we have prepared for our community, you guys. So we encourage everyone to stay tuned for our upcoming announcements and invitations. Before we
Okay.
officially end the program, we would like to have a quick survey and another photo opportunity. So may we kindly ask everyone to stay on for a few more minutes to answer the survey. So a short evaluation poll will appear on your screen shortly. We would greatly appreciate it if you could take a few moments to share your feedback about today's event. Your responses will help us continuously improve our future learning sessions. All right. Thank you. Thank you
Thank you,
once again for
Kath.
joining
Thank you,
us
Paula.
today.
Thank you,
All right.
Israel.
We hope to see everybody again in our future sessions. Hope you guys have a wonderful afternoon. Thank you so much.